Ladies and gentlemen, welcome back to the channel. We have massive news to go over that is very bullish for markets. It's so bullish, in fact, 10-year treasury yields are moving higher today by about 4 basis points upon last account. I will share with you the latest details that you need to know and what is coming next for our markets. And I will say right off the bat, I'm a little concerned about big tech, and I'm very bullish in one particular area. And, well, it's multiple different areas. In fact, if you are a stock picker, which I'm sure you are if you're watching this video, you're going to like what I have to say. If you're an indexer, you may not like this all too much. And I want to be clear, no, I'm not forecasting some kind of major crash for the indexes. I do think, though, you are going to see an underperformance of the indexes. And I will explain why small caps, mid caps, value, and cyclicals will likely outperform. Now, let's be clear. Today is Thursday. Tomorrow is Friday. We are still in 2024. In fact, next Monday, it's still 2024. Next Tuesday is New Year's Eve. And on Tuesday, we will have a half day of trading, kind of. Markets will close at 2 p.m. Excuse me, the markets will close at 4 p.m. on Tuesday, and markets will be closed on Wednesday, December 31st. So we really have today, tomorrow, Monday, and Tuesday in 2024. Still left, of course, for trading. Now, it's been clear the last couple of weeks, more clear than other years, that you are experiencing a dramatic degree of tax loss harvesting. I guess that tends to happen in years where the S&P is up almost 25%, okay? You're going to see some tax loss harvesting. And that's why big tech has really done okay the last couple of weeks. For the most part, is sitting near all-time highs. Look at something like an Apple, almost a $4 trillion company now. It's because you can't tax loss harvest Apple. You're not down on Apple. Unless you have a short position on Tesla, you can tax loss harvest that and cover on that short position. And that may be some of even what is helping to drive big tech's outperformance recently compared to the broader markets. But let me tell you, after this round of tax loss harvesting that we have seen, once you enter into calendar year 2025, the selling is going to very much slow down in cyclicals, value, industrials, and small caps, and it's going to pick up in large cap tech, okay? There's a couple of different reasons for this, but first and foremost, the biggest one is earnings growth. Earnings growth is going to be faster in small caps or in the equal weight S&P than for most big tech stocks as far as current expectations. So if we're thinking about risk to reward, what makes the most sense to invest in for 2025? And it's clearly the areas that have been tax loss harvested that have fallen the most. As I've said here on this channel before, the RSP fell 8% from its November 29th high to its low that we just had a couple of days ago. It fell 8%. The S&P fell about 4%, and 3% of that was the day of the Fed, okay? So markets fell, the S&P, the market cap weighted S&P, only fell about half of what equal weight S&P actually fell. So in reality, you have seen a correction in markets, internally in markets, but you have not seen that on the headline S&P. Again, I think because of tactical reasons. There's a tactical benefit to tax loss harvesting some of your small caps, value, cyclicals, industrials, healthcare names to offset some of the capital gains bills, the tax bills that you're going to send your clients, okay? And again, in fact, if you've been short an Apple this year and you wanted to tax loss harvest something, you could tax loss harvest that short position, thus buy back your short position and drive Apple up even more. And I think that's partly what has been happening recently. And that's why I think as we get into 2025, you're likely going to see the broader markets outperform big tech by quite a large margin. Now, I don't know if that's going to continue throughout 2025. It depends how earnings come in, if how the economy does, how inflation does. But my expectation is you will probably see the broader markets outperform big tech and outperform the headline S&P over the entirety of 2025. Again, I might be crazy, but my expectation is inflation is going to come down more than expected under Trump 2.0. My expectation is the Fed's going to be cutting rates 4, if not 5 times next year. Not because the economy's weak, but because inflation continues to fall. Okay, that's my expectation. It may be cuckoo land. It may be delulu or delusional, in other words. That's my expectation. That will help just furthermore kind of, push the broader markets higher and keep big tech kind of contained. The big question is, I think, for next year, recession, no recession, does the economy slow? Does the labor market slow more? And those are things that, unfortunately, I do not have the answer to. Today, we did get some data, okay, that kind of suggest maybe the labor market is weaker than we think. Initial jobless claims came in at 219,000. It's actually a good number, okay? We were expecting 224,000, okay? So it came in better than expected. Things are fine there. But continuing jobless claims was expected at about 1.88 million. You came in at 1.91 million. So you came in considerably higher than expected for continuing jobless claims. This is actually a 3-year high, suggesting that it's harder for people to find a new job. Maybe some people are just sitting back collecting their unemployment and saying to hell with working. I don't know, and that's why it's hard to, get a real reading from the initial jobless claims. Now here on the day today, as Mike Zaccardi says, he works with Goldman or shares a lot of things from Goldman at least. He says, this is a sleepy market. You have Microsoft in the green, Apple in the green, but pretty much everything else is not doing much or actually declining on the day today. I think this mainly has to do with 10-year treasury yields. At the time of recording this video, they're actually unchanged today. But what's fascinating is they were up to about 4.63%, almost 4.64%, and they have fallen quite a bit now. But it was really due to the better than expected holiday sales data. Okay, so this is really, really good data here. MasterCard is reporting to us that retail spending, excluding autos, was up 3.8% versus 2023. Online, excluding autos, was up 6.7%. In-store, excluding autos, was up 2.9%. All of which were very strong numbers. Wall Street was expecting 3.2% year-over-year growth. So that came in 20-ish% better than expected. Apparel was up 3.6%. Apparel online was up 6.7%. Apparel in-store was up 0.2%. Electronics up 3.7%. Jewelry up 4.0%. Department stores up 1.6%. And even restaurants up 6.3%. This is good news for the economy. Typically, even, around Christmas, if people are just not doing well financially, they don't tend to spend more money. They tend to try to cut back a little bit. And across the board, there was not a whole lot of that. It was really this better than expected holiday data that caused 10-year treasury yields to shoot up this morning. Yes, they did come down a bit, but that put a little bit of a dampen, I think, on some areas of our markets. Now, again, tactically speaking, it's tax loss harvesting season, okay, into the end of 2024. And I think pretty remarkably, pretty notably, you could see a reversal in some of the weakness in, small caps and defensives and cyclicals and value, really the broader markets coming on January 1st. I think this could be really pronounced, the outperformance of these sectors relative to big tech once we get into 2025. But between now and January 1st, from a tactical perspective, it doesn't make much sense for the markets to, outperform, to get this broader rally until you start 2025. Now, keep in mind this data was from November 1st through December 24th. So it did encompass about 2 months worth of consumer spending data. Also worth mentioning, this does not adjust for inflation, but if you did adjust for inflation, you're still in positive territory with a 3.8% year-over-year gain. So either way you want to look at it, this was strong. Now, one of the big reasons why I do think you will see this broader rally into 2025 is because markets are so negative right now. Okay, look at CNN's Fear and Greed Index. It's at 37. Nowhere near bullish, okay? You're about midway through fear. So, about in the middle between extreme fear and neutral, okay? So even as markets have tried to stage a comeback here, things are still pretty negative. Market momentum is neutral. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, neutral. Market volatility, neutral. Safe haven demand in greed. And junk bond demand in fear. We can also look at the percent of stocks trading above their 50-day moving average, still coming in at about 36%. And historically, when you're this negative, you want to go out and buy markets if we are in a bull market. This tends to be like deep correctionary levels. And I know it's going to confuse some people again, to say, hey, the last time we were this negative, 65% or so of markets were in a downtrend was August 5th of 2024. That was the day the NASDAQ was down like 6% in the beginning of trading, and the yen carry trade was blowing up in real time. At that point, the S&P, the headline, the market cap weighted S&P, the SPY was down 10%. Okay. The difference is now it's not the market cap weighted S&P. I think, again, because of tactical reasons, right? Big tech's overweighting in the headline S&P, and the fact that they've done really well. You can't really tax loss harvest those names. And you've seen an 8% drawdown in the broader markets, with a lot of stocks down a lot more than that. Okay, so in fact, markets are very weak here. The last time before August 5th was April of 2024, where the headline S&P was down 7%. And the RSP during that time, let's just pull it up because, hey, why not? The RSP during that time fell about 6.5% as well. So you are in a pretty damn negative place for overall market sentiment, right? For market positioning. Markets do not look that good right now. In fact, the latest AI investor sentiment survey that came out yesterday shows bullish investors at 37.8%, which is the lowest level we have seen at least since November. Neutral investors steadily climbing now to 28.0%, and bearish investors at 34.1%. The historical average is 31%. So you're 3.1% higher on your bear side than what is historically average. And I think there's enough bearish sentiment out there in markets to really keep the party going, right? What do they say? They say bull markets are born on pessimism, mature on skepticism, and they die on euphoria. We are nowhere close to euphoria. I think we're firmly still in this skeptical territory. Especially following the last Fed meeting, there is a lot more people that are skeptical on this market. And you need markets to climb a wall of worry for the bull market to continue. Now, again, I think we're going to shift from just big tech being in a bull market to the broader markets being in a bull market. Okay, I think that will start to really happen coming on January 1st, when you can no longer tax loss harvest, when everyone starts to think about how to position for 2025. I think it's going to be about data centers, about AI appliers. This could be Elastic or MongoDB. This could be Tesla, right? Areas like that. And then your small caps, your value, your dividend payers that probably are a little bit too beaten down. So those are the areas that I'm really bullish on for January of 2025. Keep in mind, we are technically in the Santa Claus rally period, okay? That started on Tuesday and will extend to January 2nd, which is going to be on Thursday. But really, the January effect starts to kick in at that point. And the January effect is where the first couple of weeks of January just tend to be strong. But a lot of people just think that's tax loss harvesting, right? Where you see that tax loss harvesting in December, in November, and then people rebuy those stocks in January. And perhaps that could kind of support some of my thesis here, the January effect, that is, that the broader markets could rally quite a bit in January. And really until something changes, until the economy weakens, or until we get another inflation report. You know, I think you could see a broader market rally for not just a day or two, but a couple of weeks, maybe even a couple of months. Another thing worth mentioning indefinitely is the lack of economic data that we really have, or catalyst, even into next week. Okay, we just don't have much. Tomorrow morning, you have you have good goods trades balance, expecting a deficit of 101 billion, doesn't really move the needle. Retail inventories excluding autos, wholesale inventories month over month. None of that is really important data though, okay? Monday of next week, you have Chicago PMIs, pending home sales month over month, and pending home sales year over year, as well as the Dallas Fed Manufacturing Index. Again, none of that is too important. Chicago PMIs are a little bit more important, but it's not something that I think makes or breaks our markets. On Tuesday, you have S&P Case-Shiller home price month over month and year over year. And that's Tuesday, December 31st. Markets are closed on Wednesday, so you don't have any data there. Thursday, you have initial jobless claims again. That's it. On Friday, you have ISM manufacturing PMIs. But, like, is it a surprise if manufacturing's bad? It's been bad for years now, okay? So, you know, between now and next Friday, we just don't have much for economic data, okay? When there's a lack of economic data in a seasonally bullish period for markets, markets tend to move higher, okay? Now we will get, you know, more important data towards the end of January. We also have big bank earnings season that starts January 15th. You're going to get Citi, you're going to get, I believe it's Citi. Yeah, you're going to get Citi, Wells Fargo, JP Morgan, and BNY on January 15th, January 16th, Goldman Sachs, Bank of America, Morgan Stanley, PNC, right? And then on the 17th of January, you'll get SLB, Huntington, Truist, State Street, Citizens, okay? But there's nothing between really now and then, okay? So with no earnings, not much economic data, seasonally bullish period of the year, again, after we get into 2025, tax loss harvesting ends, I see a very good setup for a broader market rally. So I don't know, guys. I don't want to fade this market. Not with people that are generally bearish. Again, CNN Fear and Greed Index, percent of stocks trading above their 50-day moving average. After the VIX spiked 75% in a single day, every single time markets have been higher 1 month later. I don't want to fade our markets when it looks like it does today. Or as Seth Golden writes on X, on December 18th, 2024, the SPX 5-day RSI fell below 20, a deeply oversold condition. It has only happened 5 previous times in the month of December. Every single time the SPX was higher a month later, with a median gain of 5%. So yeah, the way that I see things right now is people are too negative. And when people are too negative, when positioning has been reduced the way it has been, it's usually a good time to be invested in markets. That's usually when you want to be adding to stocks, not reducing exposure to stocks. Sure, is there going to be volatility around January 20th, around inauguration? Probably at some point you're going to see some tariff concerns again. But, I mean, until that happens, I think we're in a bit of a sweet spot. Just my opinion. I like the broader markets more than I like big tech, starting off January 1st, 2025. From the tactical perspective of there is no longer the case to tax loss harvest the rest of the markets. My opinion. Let me know what you guys think about this information down below in the comment section. Have a great rest of your day, and I will see you in the next one.